Occidental reporting mixed fourth quarter results, beating on earnings but missing on revenue. The energy company also announcing two deals in the current quarter to divest some of its upstream assets to undisclosed buyers for $1.2 billion. Joining us now, Stewart Glickman, who is the CFRA Research Energy Equity Analyst. Great to have you here with us. Just first, want to get your reaction to the results.
Thanks, Brad, for having me. So results pretty good. They beat handily, 80 cents on the quarter, well above the 67 cent consensus view, and actually better than last year's at 74 cents. I think Oxy is doing a pretty good job at sticking to its knitting and delivering as best it can. In an environment where oil prices have been choppy and natural gas prices have been somewhat choppy. But as far as the print goes, pretty good results.
So pretty good results, but as you mentioned, there is this challenging macro backdrop for any company in the energy space right now, given the pressure we've seen on crude prices. To what extent do you think that continues to be a challenge for Occidental moving forward?
Yeah, Madison, great question. So I think all you have to do is look at OPEC Plus and see what they've been doing over the last several months, which is continually pushing back the start of the unwinding of the 2.2 million barrels a day of voluntary production cuts. Why are they pushing it back? They're pushing it back because they're concerned about demand, and they are worried about flooding the market and sending prices plummeting through the floor. So I think there are real concerns about where incremental oil demand is going to come from. The Chinese economy looks pretty wobbly. India is growing, but India is not anywhere close to the size of the Chinese economy. And Western markets, year to year, don't improve demand all that much. So if you're not going to see a lot of growth coming from Asia Pac, where are you going to get those incremental barrels from? That, I think, is the backdrop that people are concerned about. Certainly OPEC Plus is concerned about it. And the U.S. oil community, as stingy as they're being about developing new oil and gas, or their organic spending is really not particularly strong, they are still delivering production gains year on year. We think the U.S. probably averages around 13.5 million barrels a day of oil production in 25. That's up a little bit from about 13.2 in 2024. So you've got growing non-OPEC supply. You've got OPEC Plus holding off because of concerns about demand, and of course, the demand concerns. All of that points to a backdrop where we don't think oil prices are going to be all that attractive this year. We're looking at something like $65 a barrel for WTI.
So what's that pass-through mean for Occidental here, especially as it's a stock that's been down 14% over the past 52 weeks. It seems like a lot of it has been kind of buoyed by the Buffett narrative and his buying. But outside of that, where are the other major catalysts for growth that you're anticipating to come to fruition?
Right. So Oxy has a couple of irons in its fire. One is the Crown Rock acquisition that they completed in mid to late 2024, adjacent to a lot of Oxy's other acreage. And that's important because when you have adjacent acreage, you can run longer laterals, you can squeeze down unit costs. We've already started to see that in Q4. Oxy was able to eke out about an 8% unit cost reduction on those Crown Rock assets. As they get to know the acreage a little better, there's a chance that they can probably squeeze out a little bit more. So that's a plus. They're one of the leaders in the industry in carbon capture sequestration, which is another plus for the industry. Certainly nobody wants to, send excess carbon up into the environment if you can avoid it. So those are pluses that they have that are kind of under their control. The things that are the concerns for Oxy, of course, are the macro backdrop issues that I pointed to. Mm-hmm. And Oxy also has to contend with a somewhat levered up balance sheet, right? Their net debt to cap is around 42% right now. That's, materially higher than the average E&P. Most E&Ps are going to be closer to 30% or a little bit less. So, we talked about just earlier in your intro, you talked about some non-core asset sales. Mm-hmm. I think the reason for that is that they're going to use those proceeds to help get that balance sheet back under control. higher oil prices would help, but you can't count on that, of course.
And just lastly, while we have you here, Stewart, just to follow up on the Buffett effect here, how much do you anticipate that investors are actually expecting Warren Buffett to continue to buy into Occidental, even with the allocation that he already has within the Berkshire Hathaway portfolio, and now trying to figure out, okay, even if we do see even more continued slippage, what he would feel comfortable continuing to allocate towards Occidental?
Yeah, Brad, that's a really tough question to answer. He's certainly mercurial. Hard to know, when, of course, he's going to step in and add to his position. I think that, certainly Warren Buffett has always been sort of like a believer in the long-term picture for any company that he invests in. And so him investing more into Oxy isn't necessarily a view that, the next 12 months are going to be great for Oxy. It may just be that, he's thinking about the bigger picture longer term. And to be fair to Mr. Buffett, I think longer term, the outlook for a lot of energy companies is pretty good because the lack of spending at the oil field is going to eventually come back to bite. Non-OPEC supply growth isn't always going to be positive. So we could, perhaps by the end of the decade, start to see oil production roll over because of that lack of spending. I just think that from a near-term catalyst perspective, this year looks more of a headwind kind of year than a tailwind.
Really good analysis as always. Stewart, thanks so much for taking the time here with us today.
Thank you.